Hello, everyone, and welcome to today's Forex webinar. Apologies for the slight delay in starting. We were just checking a few technical bits and pieces, not least the audio and the recording equipment. So thank you so much for taking the time out of your day to come and join myself, Anna, and David, my husband, who's sitting over the other side of the office with me, to look at the Forex market, look at some charts, look at some trades, and look at what is going on in the broader markets as well. But before we start, as you know, trading can be a very risky business. So please don't ever think of losing money that you cannot afford to lose. Because we started after a little bit of a hiatus, I know there are some new people who haven't come along to these sessions before, but as a very quick reminder, I know most of you know this, but we will be looking at the charts and this market through the prism of what we call volume price analysis. That's the technical analysis side. And when we look at the relationship between the price action and the volume, support and resistance, candles, candle patterns, and time, and particularly multiple time frames, and that's really important. And in fact, it's the first analysis that I'm going to do in this session, which is a look at the euro dollar. But when you are trading the Forex market, in fact, any market, to be honest, you also have to be aware of what's going on the fundamental side. And at 1:30 here, I've just looked over on to Financial Juice, and you can pick it up at Forex Factory as well. We have some very important data. We've got the PCE and we have the jobless claims. Now, if you were listening to Jay Powell at the Jackson Hole, his little speech that he did, it was very short. It was a bit of a strange speech, actually. He was talking about not being able to be guided by the stars because there were clouds above him. I don't know, maybe there's something in the water up in Wyoming. Who knows? But he kept making this point about the inflation rate, but he also made the point about the PCE. That is the Fed's preferred metric for inflation. And I think he said it, and forgive me if I have slightly misquoting him, something along the lines that it has to get to 2% before they will even think about reducing interest rates. Whether that they're going to keep to that, whether the market even believes that, is another issue. But that is what the market is waiting for at the moment, waiting for this PCE number and obviously the jobless, the unemployment claims. Because the other point he made most strongly is that unless the employment of the jobs market employment deteriorates quite significantly, then they will carry on with their path of raising interest rates. And I think, as I've mentioned in a previous webinar, this going back some time, there was a point in the UK here where we had a previous chancellor who was asked this question about unemployment and basically trashing the employment market, causing it's a price worth paying if you want to get inflation under control. Not going to go into the morality or the politics of it, but that is their thinking behind being so focused on what the jobs market is doing at the moment. So that's the fundamental side, that's the macro side. But we also have a look at what's happening in related markets in terms of risk on and risk off, because those of you who have been around the Forex space a little while will know that risk is reflected in individual currencies and also in different currency pairs. So that's where that's the basis of where we start from in this particular session. Don't often talk about the euro dollar. Not a pair that I'm that neither David nor I tend to trade very much. I don't know whether it's a prejudice towards the euro dollar. I don't know. Part of the reason, until recently, is it can be it can trade in a very narrow range on a daily basis, which can make it very tricky. Having said that, we understand why traders really like to trade it, because your broker will offer you some very tight spreads. It's so liquid. It's such a hugely liquid pair. Doesn't mean we don't trade the euro. We tend to focus more on the cross pairs. I have TradingView up, but I've also got MT4, and we can see basically where we are with the euro at the moment. And there's a narrative that I just want to go through with you as we come up to the 1:30 news releases, as I said, to do with the PCE and the jobs market. And it's really this piece of price action that we have here on eurodollar, this really nice move lower that we have here. And you look at that, and obviously if you join the session where we are now, you think, oh my goodness, what has been the story behind that? And are we now at a potential reversal? And we can see here that the pair has tried to rally on a number of occasions and has actually run into this significant resistance here, as denoted by the S4 of the Camarilla pivot. It's one of those levels in the Camarilla indicator. It's that the third and the fourth are probably the two most important if you want to give it a sort of hierarchy, as it were. But I've been looking at this pair since this morning, and I just want to talk you through very quickly as to what I was looking at and why was there a trade to the downside in the first place. And this is where we come to our multiple timeframes, and also an awareness that obviously when we come to a session crossover, all sorts of things can happen. Now, whilst whatever may have happened in the previous session, and here we're talking about Asia Pacific, is going to be significant because levels of support and resistance levels will have been created, and they, if you like, will act as support and resistance in what happens when there's Eurex. Eurex is the European Open, which is at 7 o'clock our time here in the UK, and then of course you get the notorious London session. But it really starts with the daily chart, which is where I think if you're an intraday basis, it's a good place to start. You can by all means look at the weekly at the beginning of the week, and certainly we're coming to the end of the month. Then a look at the monthly chart can also be helpful. And what we have here, we can clearly see eurodollar has been on a bit of a sell-off, if you like, ever since we had this very, very nice, very classic shooting star candle. It was a strong signal, and a signal actually that followed through. Often when you have strong signals such as shooting stars or hammers, sometimes you get you do get a little pullback before the signal is validated. I suppose it's really, we always say don't go off one signal, but on this occasion it did actually deliver, and it's been in this, I'm not saying free fall, but it has been moving lower. We can see here we've got lower highs all the way down. But on a daily basis, most unlike eurodollar, I think you'd agree there, David, wouldn't you? Because we've had some horrible narrow ranges for the eurodollar. We've had some really big candles, so there's obviously been some nice opportunities on an intraday basis. So down it's come. And what really caught my eye is this was last Friday, where we had it's a kind of doji, but a doji really needs to open and close at the same place. It's got a little body, but obviously you've clearly got some buying coming in here because you've got a wick to the bottom of the candle. So you could argue, there is potential for a reversal, and we have seen that on the first 3 days of this week. But what really caught my eye is look at the volume. I know it's August, but it's at the end of August, and we've had some decent volumes all through August at a time when most of Europe has been laying on a beach somewhere. And suddenly you've got these three nice candles, and look at the price. This is an anomaly, doesn't seem to be genuine. And at the same time, the price action yesterday also stopped. Here we are, we've got the volume point of control, and we have this very strong resistance in the 1.0925. So that's where we are. And I looked at it earlier this morning, and I thought, do you know what? I wouldn't be surprised if we are going to see a reversal today. So that's where we started. Now, my own preference for time frames is I have a Renko, which is not a time frame chart, but it's a non-time frame chart that those of you who come along regularly will know. Renko helps us with entries, exits, but much more importantly, it helps us to keep us in a trade, and it takes out all the noise, if you like, that you can get from candlesticks, from wicks and what have you. So I have a Renko, I have a 5 minute, I have a 15. Now I don't have the hour on here. I've got the daily, but I also have the hour, because the hour is like a benchmark chart. It gives me those support and resistance levels on a slower time frame where I know maybe that's where the price is looking to pause or even looking to reverse. I also obviously have the currency strength indicator. And what also caught my eye this morning is we've obviously got the sell-off here from this is the hourly CSI. And the reason I use this hourly CSI is that it captures the price action in the 3 sessions quite nicely, so you can do a kind of comparison. And euro had been selling off, and you think, well, why didn't you see that one? Well, this is 1 o'clock in this is Asia Pacific time, so euro was obviously was selling off at that time. But was it selling off strongly against the dollar? And what we have here, we don't really have a lot of divergence. We kind of see the dollar going in the same direction. Then the dollar starts to kick up, whereas at sort of 5 o'clock this morning. But what really was of interest, because this is the time I came to my computer, was this cross. And with the CSI, we always look for overbought and we look for oversold, which is great. We look at that, gives us our reversals. But sometimes, if you've missed that reversal, the cross on the CSI is a great, it could be a great opportunity, and it's a signal for you to go and explore this in more detail. And if we look at the timestamp of the cross, that's actually London, which is 8 o'clock, obviously. But if we look at 7, we can already see the euro was on the move, and so was the dollar. That's what we want to see with currencies. We want to see this, as I said, this. They've got to be moving apart. They've got to be either coming together, moving apart. You don't want them going in the same direction, because in the same direction, the chances are they will be in consolidation. That doesn't mean that there may not be movement one way or another, but you're going to get an asymmetric move, which is really what you don't want. So that was the CSI. I thought, great, let's go and see what the 5 minute chart is up to. So off I go to look at the 5 minute chart. Now, you'll notice here the VPOC has actually moved down, which is why I took a screenshot of this. Let me just bring it up if I can find where my downloads are. Let's have a look. Let's have a look here, downloads. That one, because I wanted to show you what it actually looked like this morning. Right, this is what it looked like at 8 o'clock. It was about 9 o'clock by the time I came to my system. And where we have, this is what we have here. This is obviously Asia. This is Asia Pacific. I'm not awake. This is not the time, and this is not the session that I get involved with. This is the Eurex. This is the open for Europe. And this is what I'm saying about these support and resistance levels that are being built during consolidation phases. The accumulation and distribution indicator, which we call this here, which gives us these levels, it gives us these ceilings and this floor. The thicker these lines are, the stronger these levels are. And we can see here, it made a sort of a few half-hearted attempts to break through. Then it broke away from the resistance, and also the volume point of control. So obviously traders were possibly looking at a breakaway trade. Nothing really happened. Went back to test it. Then we have the volatility that always accompanies the London Open, and we have this huge inrush of volume. And this is where it really took off. Now, if you notice this candle here, obviously that's got a wick to the top, but while it was forming, it would have gone through those levels. You got this, the wick wouldn't have been there. That's when traders get trapped. That's because they see the price, it's moving quickly. Maybe they use volume, maybe they don't. They don't wait for the candle to close, and they say, well, do you know what? It's been moving up for 3 days. It's had a bit of a pullback. I don't know. I think it's going to go long, and the dollar has been selling off as well. So whatever rationale they have in their mind, off they go, and this is where you get trapped with at the London Open. But in fact, what happens is you have the start of this move lower. It's got momentum, it's got and it's got volatility, because we know we've got the volatility indicator being fired off on all these candles. Where's it going? This is where we look at support and resistance, and we use either support and resistance from the accumulation and distribution, or you draw these on yourself manually. You look at the Camarilla. Is that a significant Camarilla level? Maybe it is. You would expect it to pause. Then you have this little pullback. You've got a decent amount of volume under there. So what you look then, you look at the spread of the candles. Yeah, you've got, that one, it seems spread's increasing, that's increasing. Volume's not increasing. That candle is bigger than that one. The volume is slightly lower. Then you have this very narrow candle with a little wick to the top with a lot of volume underneath it. We say, well, hold on. If that's going to go higher, that's got to go, that should have been up there. It's not. So that is a warning signal. When we look at anomalies, we either look at them from the perspective of the spreads are widening and the volume is falling away, or we look at them, the spreads are narrowing and maybe the volume is increasing and it is a lot of effort going in and you're not getting any result. And in fact, it carried on lower. So, but I wanted to highlight this because the volume point of control was out there. It's now moved down because the volume point of control is dynamic, and it moves whenever we have a long congestion phase. You can see the little bulge in the VPOC here. As soon as that is bigger than that, the VPOC comes down. And what happens is, depending on where the price action is, when it moves down, it's either going to be supportive. In this case, looks like we're going to get a bit of support, or it becomes even stronger resistance. The Renko I have on this chart is what we call the time adjusted one that's only available for trading view. It's very, very different to any other Renko that's out there for any other platform. And what it does is we know we say Renko isn't to do with time, but we've actually managed to trick time, as it were. So it moves in tandem with the time chart. And what we're looking for is, obviously we see this red, not very well expressed here, but basically once you're in a move, if it helps to keep you in. When it starts to move sideways and we have a little bit of green here, that means we're in congestion. But the exit for this particular move, which I think could have been either 45 or 55 pips, we need to look at the other time frames. But this is where we are at the moment. And the end of this move lower came on this candle with this massive volume underneath, but it was a volatility candle. There was a lot of momentum underneath it. I thought it was probably going to stop about here. You can see this blue line here. This is actually a line that I drew in myself. Let's have it here. Yes, it was a line because I was looking for a potential target or potential stopping point that wasn't Camarilla based. In fact, it does tie in with a Camarilla level. And what I did was I drew a line. As you can see here on this candle, I drew a line above the wick, the close of the candle, and it corresponds with some levels that we have over here. And then I drew another line, which was at the bottom of the wick. So I thought, well, if it's going to stop, it's going to either stop here or pause or at this point here. What happens when prices are moving, particularly when they're moving lower? There's always an overrun. And this is where, you get momentum coming in, and it looks like it is going to go further. And sometimes it does. But having moved already up to there, 45 pips. And if you're in this move and you banked most of them, you think, do you know what? Is it worth it? Come out on the volatility candle. And in fact, the price did retrace into the spread of the candle, and it's been moving sideways ever since. And if we look at these two candles here, this is the volatility candle and the little up candle next to it. And this is the importance of multiple time frames, because if you look at it on the 15-minute chart that we have here, I'll just expand that up a little bit. What do we see? We have this volatility candle, and we have a wick to the bottom of it, which is why it's so important to have multiple time frames. That's buying coming in. So if you were sitting in this trade and you were looking at both the 5-minute and the 15-minute, and the 15-minute, you could see this momentum coming in, and suddenly all this, the price starts to go higher and higher. You don't have to wait for the close of the 5-minute candle. There's buying coming in. You might as well come out. And interestingly, I said about these two levels, this lower level is very close to the S4. As I said, the two most important levels on the Camarilla is the third and the fourth. So we would expect to see a pause at this point. Where are we at the moment? Well, we're in quite sort of messy price action. We are the VPOC here hasn't moved down, but it has moved down on the 5-minute. We're around the fourth level, so there's been a bit of toing and froing as it were. We've got a nice hammer candle here, which we've had a little move higher, and that's pushed it up above the S4. And we've got 3 minutes before we have the news. And this is what you will find again and again. You will look at a chart and you will see, there'll be a move that has happened and it's finished and it's going into congestion. It doesn't look as though it's going anywhere. Just look at the time, just glance down at the time, look at the calendar, and you think, that's what everybody is waiting for. And that is what we're waiting for in the next 2 minutes. Very quickly, we can go and certainly have a look at see how that is reflected on our MT4 platform. And in fact, on the MT4 version of the Renko, that's the move lower that we saw. Trend monitor, this is the piece of price action I'm referring to, and in fact it's now gone to bright blue. That's slightly over the S4, but even though from a technical perspective you would say, yep, that looks great, nice setup, because we have this news in 2 minutes, you really must wait. For the sake of a couple of minutes, it's not worth it, because you really don't know what's going to happen, particularly in this case, particularly with the dollar. If we look at the hourly, we've got the CSI here as well. This is the cross that I mentioned. We've seen the dollar has kind of begun to turn over. The euro as well certainly lost that downward momentum, because the angles that you see, the steepness of the lines that you have on the CSI also gives you a really good clue as to whether there is some momentum behind either the buying and selling for that particular currency. And if we just hop over to the matrix, the hourly CSI with all the currencies on there, and the Dixie, the DXY on the daily. This is what I mean. This is the fall that we saw in the dollar. That's the buying that came in yesterday. That would have told us that today, certainly at the beginning of the Europe session, or even overnight, we would start to see that buying would carry on. And the depths of the wicks are pretty good. If you see a really deep wick, you can be pretty certain that, yeah, we're going to have some, that's going to follow through. It may not follow through a lot, but it will certainly follow through. And in fact, the news has come out. And looking at the other currencies, we can see here, I looked at cable as well, but it wasn't moving as well as eurodollar, but that certainly picked up a little bit of speed as the morning has gone on. Aussie and Kiwi haven't done very much. Yen has been moving higher, and the Canadian, well, as I said here, the Canadian and the dollar have been moving in tandem. We really want to see a divergence there, a pulling apart. And we would, with the Canadian, we're coming up to North American session, so you would expect more interest, more participation in that particular currency. I've just made some notes. I just want to make sure I've covered everything there. I've told you the news, the multiple time frames. Let's have a quick look, because there was really a lot on here. Support and resistance to tell you where it was going. You mark those levels on your chart. If you have an indicator such as accumulation and distribution, you've got the added advantage of it tells you how strong and how weak they may be. Momentum carries the price on. You always get an overrun. So support and resistance, you have to treat it with, you have to give them a little bit of flexibility. we're talking more about zones. If you really want pinpoint, then this is a trick that somebody showed me a little while ago. If you change it to a line chart, then if you really want to be more sort of pinpoint, then turn it to a line chart, and you can see exactly where those reversals are. But personally, I would use, the zones, be a little bit more flexible. It's be a bit more discretionary with them. Now, what's also interesting is if we look here, because that came through not speed, but the rate at which this price fell, we have what we call a low volume node on the volume point of control. What happens is when price then goes back and revisits it, if it's like this and it's a low volume node, in other words, the histogram is very narrow, you will find that if price is going to go through, it's going to go through quite quickly. When it comes into those sort of bulgy areas, then it's going to be stale, it's going to be stagnant. It's really, most of the time, it is going to struggle. Quickly, just have a look at the hourly chart to see what happens on Eurodollar. I don't think there's been much of a reaction, David, has there? On the march, is just messing about basically. Let's quickly go Eurodollar again. See the hourly chart here. Let's have a look. Yeah, we've got 3 candles here with wicks to the bottom of the candle. So we've obviously got some buying coming in here, and on this chart we're also at the S4. The levels on the Camarilla work in this way. Time frames up to but not including the hour, they are recalculated every day. So you will have new levels every time the session flicks over. On the hourly and up to the daily, this is going to be here for the rest of the week. And as we can see here, we've got some resistance up here as well. So if this is going to reverse strongly and go back to where it started off earlier in the day, it's going to take some effort to get through there. We've had this is the hourly chart. It's had one go already, and it's already pulling back. You just have to be patient, basically. Right, I think that's everything. Levels, 15 minutes. Yes, the 15-minute chart showed us why it was a bit of a struggle to reverse higher using multiple time frames. And you can always go down on the CSI. You just go down to the 5-minute chart just to see what they're doing and look at that. If they carry on going in the same direction, this is not going to go very far. We really do need to see some decent divergence. Right, I'm going to pass over to David because he's going to look at Eurodollar from the perspective of the volume, the strength indicator, the strength of the volume, to see what that can tell us, and also what it's doing at the moment, and hopefully go and find another pair that's perhaps presents us with a better trading opportunity.
Anna said, "Where is the VRSI?" I said, "I'm just coming to that." Hi everybody, good to see you. And yeah, I'm staying with the Eurodollar. I will go to the volume relative strength indicator in a moment, but I wanted to start here on the just the regular time frames with, I've just got the VPOC on here, and I've also got the volatility indicator. And we go from 15-second in the top left right the way down to the daily, but primarily in the faster time frames. And the reason I just wanted to stay with this for a moment is that we have got some absolutely classical traps being created here, and not only through the prism of volume, but also through the use of the volatility indicator. And to be honest, they're all over the place. You can see them without me even enlarging the screen. If you look at the volume associated with this candle here, completely out of whack. You don't need to know really anything else about volume price analysis than to appreciate that for a move of that size on that volume, then clearly if this volume here is in the same session and we call it our benchmark volume, then clearly there's something wrong. You can see the same over here on that one. I'll pop these open for you in a moment. We had a classical trap move before the news at 13:15, about 15 minutes beforehand. A nice snap move higher. Volume was relatively low again on this one, and the market retraced. And then we had the news come in on this one, and again, nice volatility candle. And they're all over the place. You've got them on the 5-minute here as well. But if you look at it from a volume perspective, let's just pull really any one of these up, doesn't really matter. This is on 1 minute. If you look at the volume associated with that candle, if this is genuine volume, and there's no reason to suspect that it is not, in other words, this is more typical of our benchmarking, then a candle of that size should carry volume of at least 2 times that, maybe more. So it makes absolutely no sense from a volume perspective, and therefore no surprise to see that we've had the trap. Traders have jumped in on the news, and they're now paying the price for that early trigger. And as Anna said, it is a question of waiting and being patient, and volume brings all this home in a very, well, I was going to say a very cold and calculated way, because that's basically what it is. When we're using volume price analysis, and it's something we've talked a lot about over the years, when you're looking at volume, you are analyzing, you are in an analytical mentality, an analytical frame of mind. You are not in an emotional state where you are chasing price, where a lot of the emotional pressure comes through the fear of missing out. These volatility candles are absolute classics. It's FOMO. You will see the price move quickly. You will want to trade it. You will jump in, and then you're trapped at the top of the candle. And that is what the market makers understand all so well, and they use it all the time. And they have a constant stream of news with which to deliver the fatal blow. And the other reason for using multiple timeframes, of course, is that, put this one up full size, is that you can see things like the volatility traps in different timeframes. And if you see them coming in slower timeframes, as indeed they did just prior to the news releases coming out, I think we had one on 3 and one on 3 and one on 5. When you get them on slower timeframes, they are even more important because, again, as we stressed many times, the slower the time frame, the greater is the significance of the information, whether that information is a support and resistance level, whether it's a volatility trigger, whether it's something to do with VPA, whether it's accumulation distribution, it doesn't matter. The slower the time frame, if you see a signal in a slower time frame and it's against what you're doing in your faster time frames, it is hugely significant. The other aspect, the other reason I wanted to show you this workspace as well was really just to demonstrate where we are in terms of the VPOC. The VPOC is the yellow line. It's the fulcrum of the market. Where are we going? Let's go up to 5 again. Let's pop that one full size. It's the fulcrum, and as you can see, it is the heaviest concentration of volume way out here. This is where the market has been sat. It continues to sit here. It is where the price is in agreement. There is no disagreement. In other words, there's no bias to the bearish side or the bullish side. It's a tug of war where both teams are equally weighted, if you like. And that is where it will sit, and it will continue to sit there for some time until volume is sufficient to drive it away. The beauty of the VPOC is that if I put the accumulation distribution indicator on here, I'm not going to, because this is just a particular workspace I use a lot for just with the VPOC. But if I put it on here, what it would often do is create very strong levels of ceilings of resistance and platforms of support. You get this wonderful channeling effect around the volume point of control. So using the VPOC and you're using the accumulation distribution indicator in conjunction together with one another. What that then gives you is very clear levels against which to judge a breakout, whether it's the upside or the downside. You don't really care. If you're a trader, you certainly shouldn't care at any rate. And all you're waiting for is for that market to break away from this region and you then have the perfect triggers, if you like, above and below, they will give you your entry. It's not a case of entry, oh, as soon as it's hit that level, I'm going to enter. It's a case of, okay, defining that region, and then once the price has closed below that region or above that region, assuming that candle has been delivered with good, strong volume and has not got major wicks one side or the other, but is a nice, solid candle with good volume under it, then there is absolutely no reason that you can't enter a trade based on that. The problem that most traders face with taking that approach at any rate is patience. I'm sitting here talking to you, I'm looking at the chart, and we're just having to be patient. I don't know when it's going to break. All I can tell you is that it's not going to sit here forever, because it can't. No currency can, no stock can, no ETF can, no index can. It will have to move at some point. So all I have to do to succeed or to enter my position is just be patient and wait. I have my levels pretty clearly defined for me. And the other wonderful thing about trading from such regions is that it gives you the perfect positional point to place your stop loss. You really don't have to give it any great thought. If this breaks to the upside, you place it somewhere down here below this lot, maybe a little bit higher if you wanted to go to this next level up. If it was, and provided everything is within your risk and money management rule, fine. To the upside, if it breaks the downside, you might want to put here. You might alternatively want to go a next step up and go above here, but somewhere around that region. And then you have the perfect barrier, the natural barrier of price. This is the market telling you where to place your stop loss. It's not me. It's not I'm dictating. I'm not using other indicators. I'm not using RSIs. I'm not using anything to give me a guide. I am just merely using the chart. And that's something we've done pretty much from day one. It's just the way that Anna and I were trained, I guess. And it just seems to work for us. Not everybody uses that approach, but it's the one we use all the time. Excuse me for a moment. Sorry, I just had a frog in the throat. So I know I've diverted away a little bit from where we were, but it just reinforces that perspective and that opportunity that you have. And as I say, all you need is to be patient. And the same is true. I've been doing some videos with the market strength indicator, which works in a very similar way to the currency strength indicator, where we're looking at extremes all the time, or trends, strength of trends, angle of inclination. And as talked about separation, you're always looking for that separation. You're looking for one currency rising very strongly and another currency falling very strongly, that divergence, where you've got two trains traveling in opposite directions or against one another, and they are moving very fast. You have momentum. But equally, if you're looking at reversals, and those of you who know us very well and you come along regularly, you'll know that I love trading reversals. Trading reversals come at a price, though, because you have to set a wider stop loss to allow for the time that a reversal is going to take before it develops, and therefore your risk on the table is much higher. You have to allow for it in a wider stop loss, but your payoff is much bigger because you're getting in at the start of the trend. That's the payoff. It's like going to the theatre and paying for a higher price ticket. You're paying for the best seat in town, so you expect to pay a premium. If you want the best seat in town in terms of a reversal trade, you've got to pay the premium, and the premium is a wider stop loss, which comes at a price. But your payoff is much bigger. If you're a trend trader and you don't want to take that approach, or you're not patient enough to take that approach, then you jump on a trend. And jumping on a trend is absolutely fine. Once the trend's underway, the train is moving, your entry price is much, much lower. You're down in the stalls somewhere because you are not taking the same amount of risk. You're just paying a relatively small price. Your stop loss is much closer because the trend already has momentum. You're not having to be patient, and you're not having to take time and wait and put a bigger risk on the table in return for a bigger reward, because that's all investing and trading comes down to at the end of the day. It's risk and reward. The more risk you put on the table, the higher should you be your reward, and vice versa. So that's where we are on the euro-dollar. So I wanted to show you all of that, particularly the trap moves. You can see it going on. It's very clear. And we're also trading a lot around the VPOC as well, indeed, as we are down on the daily. If I just pop that up full size as well, pull that out a bit compressed. There we go. So where is the euro-dollar heading? Well, we're at the VPOC. If it's going to head lower, then as this volume falls away, we've got another pretty big chunk of volume here, which you can see came to its aid at 1.08 more or less. If it breached that, then the volume falls away quite dramatically, and we're likely to go down to this sort of level again, where we've got low volume nodes here. To the upside, a lot of volume in here, so that's going to take a huge amount of effort to push the price up through this lot. Once it gets up to this level at, where are we, 111 on, 110.50, 111, volume is much lighter. And volume works in exactly the same way as it does with price-based support and resistance. We're all very familiar with support and resistance from a price perspective, but volume works in the same way because it acts as resistance or support. So where you've got heavy concentrations of volume, and you've got the heaviest here, obviously, so when the price gets down or up to this level, if we were trading off here, for example, and the market starts to rally and we think, great, okay, once it starts to approach the VPOC, it may or may not have been at this level, I can't tell you. But if it had been at that level and the price is approaching it, then the only thing we can expect with any certainty is that the market is going to congest. It's very, very unlikely that the price is going to blast straight through that region because volume acts as resistance at that point. And in the same way, it acts as support in a down move. So when the market comes off this high, we come all the way down, we know that the market is going to, at the very least, is going to congest. So if we've got a good position and we've got a load of profit sitting in that trade already, we might as well take it off the table, because I don't particularly want to sit through congestion for the time being if I've got decent profit that I can bank, or maybe just reduce the exposure. If I've got multiple lots or multiple contracts on, then I'll just reduce it down and have leave maybe one or two to run, take the bulk off. So that's where we are. Let's go to VRSI, which is the volume relative strength indicator. If I can find it, I've got it on the stocks, but I have actually changed it to eurodollar. There we go. And this is a new indicator. If you came last week, I did spend quite a bit of time on it last week, but I'll run through it very quickly here. The workspace that I've created here is on the top line, we've got the 1, 5, and 15 minute for eurodollar, with the volume relative strength indicator below it, underneath on that chart here, these colored bars here. And on the lower three charts, I have a conventional just got volume on there. I've got no other indicators, just got volume. And the reason I've done that is because the volume relative strength indicator is always used in combination with our volume price analysis methodology. And I leave it this way just to reinforce that point. In terms of how the indicator works, just hop up onto the 15 minute. I'll just run through that briefly for you. By the way, this indicator it will be released. It's available, or it will be available on NinjaTrader and TradingView initially, and then we will get it ported over onto TradeStation in due course. But all these new indicators that you see today, last week, and in the next few weeks, they will be available once the stock trading investing program is rolled out in full, which is going to be a few weeks' time. I know we've been saying that, but literally there's a ton of work that we still have to do, but we are pretty much close to the end now. But there's a lot of sort of snagging and tidying up that we need to do just to make sure that everything works fine. The volume relative strength indicator, as you would expect from the name, is an extension of volume price analysis. It is looking at the relative strength of volume and trying to give us a view, an internalized view, if you like, on the strength of trends as they develop, or indeed the strength of congestion. And as you'll see from the videos, once we release them on the indicator, we talk about pressure, because really that's what it's about. It is about the pressure that accompanies a trend, and whether that trend has got real pressure behind it, or whether it is lacking pressure, whether that pressure is diminishing, or whether that pressure is increasing. So that's really the conceptual idea, if you like. It's the whole idea of using relative volume to describe the pressure behind trends. And one of the reasons we developed this indicator, in addition to adding to the portfolio in terms of our volume indicators, it also enormously helpful in terms of helping to keep you in a trend once it's underway. It's exactly the same conceptual ideas we have with the trend monitor and the trends, if you're familiar with those two, whereby we are trying to help you and our students and our customers and us, I have to say, because we developed them ourselves originally, to maintain a trend and not get shaken out when we get a reversal against us, which is always the point, going back to what I was saying earlier about emotion, is when emotion becomes the trigger and not analysis. Volume analysis is that your brain is in an analytical mode. When it's in emotional mode, it reacts in a completely different way, and that's why VPA is so important, because it stops us being emotional for those few precious seconds when we want to do something through emotion, but common sense and analysis would tell us not to do that. It's as simple as that. And this has been developed in much the same sort of framework, if you like. The way it works, I'll explain it very briefly. We have a fulcrum line here, which oscillates between bullish and bearish, or bearish and bullish, depending on which way we're going. So that is always a point of reference that we're looking at. We then have color coding. We have darker colors for very strong sentiment, weaker colors where that sentiment is waning. So this is dark, this is very bearish sentiment, and this is where the bearish sentiment has waned a little bit. We've gone to a lighter color. Exactly the same over here to the bullish side. We've got very strongly bullish dark colors, and then where that sentiment perhaps is waning, we start to see the color change and shift to a lighter color. So that is the second element. There's three elements of this indication. The third element is to do with the height of the column, the bar, if you like. The taller that bar, the stronger is that momentum, the pressure behind it. And therefore, when you look at trends and you look at comparing the heights of volume bars one with another, it's very much like comparing on your VPA analysis, where you're comparing the height of a volume bar with another as a benchmark, for example. It's very similar here. This is why we like this indicator, love this indicator so much, is because of the parallels. When you're analyzing it, when you're analyzing volume, you are constantly looking at benchmarking. You're looking at interpreting the relationship between related bars. Is this one higher? Is this one lower? How does it relate to the candle? You're doing exactly the same here. So what we're constantly looking at are those three things: the fulcrum here, the color, and also the height of the pressure bars themselves. And then, as you see, we get these areas of bullish momentum, and then that sentiment is draining away. Why is it draining away? Because the height of these bars is falling. It's falling constantly. We get little punctuations of a repeat of perhaps bullish sentiment, but it really amounts to very little, because the height of the bar, the pressure bar, tells us that really there isn't a great deal of strength behind that. So this little rally, if you like, which these are the sorts of rallies when we're in a bearish trend which can be so damaging. If we see this sort of very weak effort, a weak effort in a rally, in confirmation, of course, with our VPA, straight VPA analysis, it would really confirm to us that, do you know what? There is no emotion here. I don't need to worry too much, because I don't think that that rally is going to amount to much. Then we move into these areas here, and these are equally important because the height of the pressure bars here is very small. It's telling us we're in congestion, and that would be confirmed with the spreads of the candles being very narrow, with our volume being relatively small, probably no great variation in volume. Similar sort of thing here. We're moving into a mildly bearish trend at this point. And this is the other aspect of the indicator. We look at I've talked about steepness of the lines in terms of the currency strength indicator, and the market strength indicator is the same, where you see very steep, very steeply angled lines are telling you about strength of trend. It's exactly the same here, although we look at it in terms of the height of the pressure bar. So where we've got this mildly bearish trend low, it's just deflating, basically, would be a good description. The height of those pressure bars is very similar. They're not growing in height. They're all pretty much the same. We know we're in bearish territory because we are below the line anyway, but there's really no pressure behind it. It's subsiding, if you like. And then we get the injection of pressure here. So we get these two candles, we're breaking away. We'll look at the volume in a moment, but the volume strength indicator is giving us a clear signal why we've gone way from the fulcrum. We've changed color to very dark, and the height of those pressure bars has now increased. And what's interesting about this particular trend as well, and this is another nuanced aspect to the indicator, if you will, is that once we get into a trend, when we want to see, what we really want to see to help us maintain that is that the height maintains a pretty steady regime through here. It really doesn't start to diminish to any great extent until we get down to the end here. And even when we get this little punctuation here, it's really telling us that, you know what, and going back to what I was saying about comparison, benchmarking, these bars here compared with these ones over here, much smaller. And yes, okay, we've got maybe a pickup in the bearish trend, but it's really not developing well. The bars, the pressure bars are not increasing in height. If this were going to be a pickup and we see this reversal and then we're going to see this crash down here, ideally what we would want to see here is we want to see these really going up quite fast, but they're not. They're all pretty much the same height, and they're much, much lower than over here. So again, you look at these aspects, and this is what I mean by the volume relative strength indicator has a lot in common in the analytical, the way we analyze it and the way we do with our volume price analysis methodology. And even when we get this injection of what would appear to be quite a strongly bullish candle, we had a very small pressure bar associated with it. So yeah, okay, we've gone from bearish into bullish, but really it's very low, and there's absolutely no follow through on the next one. You can see it's come right the way back down to a sliver here, and we've rolled back over into bearish again, and we've gone back to our dark orange. So all of that, this little area around here particularly is telling us, yeah, okay, we've got a bit of bullish sentiment come in, but it doesn't look like it's likely to develop into anything much. Obviously, looking at our time charts we were just looking at earlier on, we know we've got a lot of volatility. So there's a lot of whipsaw price action in here that we're not seeing because obviously we were looking at the much faster time frames. I haven't got the volatility indicator on here, but that's what that would all be telling you as well. And again, it's a question of being patient and now waiting for a breakaway from this congestion region, which is now developing at this level, down perhaps on to the next level. Let's just pop that back down. And then we're looking at all of that in the context of, just move that out of the way, the chat box, of volume price analysis. And if we hop up onto our 15-minute time frame here, huge amount of volume come in under this particular candle. Big wick to the upper body, lots of volume there. So that is not giving us a very strong signal that we are likely to see a bearish, a bullish reversal at any point soon. For that to happen, we need to see some strong buying. We've got a little bit of buying coming in on that one maybe, but again, it's about levels, it's about congestion, and setting those levels, the upper ceiling, the lower floor, and then waiting and being patient if we're going to take this as a trend reversal. Of course, if we are an intraday trader, this is the 15-minute time frame, there will be plenty of traders in there on 15-second charts and upwards who will have made money in here. Absolutely no problem at all. Good luck to them. I'm on the 15-second chart a lot. You've seen those workspaces I have with a 15-second up to 1 minute. The 15-second is a great chart if you're able to deal with those fast time frames, and it's not for everybody. The one mechanism or the one way of using it I would strongly suggest is if you're learning volume price analysis, stick it on a 15-second or a 30-second or a 1 minute, because it's a great way to read VPA quickly and get up to speed quickly. We had to do it with paper charts back in our day, with huge great screens and paper charts. We used to test one another, but nowadays it's very, very simple and straightforward to do that. Gosh, we've run over time a little bit. I think that's. Is there anything you wanted to add to that, Anna, darling?
Unless you want to see it, let me just have a look at another potential pair. Just
while Anna has a quick look, let me just hop over onto Trading View. Let's just see what's going on here. This is the market strength indicator, which you might think looks has very similar commonalities to the currency strength indicator, and you'd be right, because it is a sister indicator developed with the same sort of principles in mind. What you're looking at here, we're looking at the indices. I've got the index futures on here. Got 4 of them. I've got the YM, the YM, the ES, the Russell, and also the ES, Russell, YM, and which one am I missing? NQ. So I've got the 4 of them on here, and what I've also got, this pink line here, is the VX, that's the VIX futures. So you are looking at an inverse relationship between what is the sentiment at the moment, what is the market sentiment saying. Admittedly, we've got half an hour to run to the open of the US session. So we're running in Globex here. We're not running with Globex and cash markets open. This is purely electronic. That's where we are at the moment. You can see the NQ here has dived quite strongly. But the inverse relationship you see here is a classical one. We're all very familiar with it, but the market strength indicator really does show it very well in terms of the fact that we get these peaks and troughs. We've got the peaks here, we've got the highs of the indices moving up into these very strongly overbought areas, and at the same time we've got the VIX itself, the VIX future, moving down into oversold. And the other beauty of using the futures is that we also have volume. So we have volume on the index futures, and we've also got volume on the VIX futures as well. So we get that wonderful inverse relationship, which is very classical, is in the forex world, of course, it's euro dollar, dollar Swiss. And if you are a big euro dollar trader, I would urge you to use the dollar Swiss chart in that way, because you get an upside down view of volume. So if you're seeing an upthrust on your euro dollar with lots of volume, then what you should be seeing on your dollar Swiss is the inverse of that, which is a hammer with lots of volume. And that's the beauty of it. And maybe we'll set that up next time just to show you it in action. But it's just if you can find these relationships, and there are a lot of them in the stocks and commodities world, in the forex world, and which reminds me, over on where are we? Let me just hop back onto Ninja for a moment. Sorry, let's just get rid of that for a moment. Where are we? Here we go. On this workspace, I've actually got the correlations here. Let's have a look, see what euro dollar. We've got euro dollar here and dollar Swiss. Where are we? Here we are. And it's interesting, isn't it interesting? It's minus 0.49. What does that mean? It actually means that there's very little correlation right now. This is on the hour. Can actually change this, but I've got it on the hour. So at the moment, between euro dollar and dollar Swiss, there is very little correlation. And normally, the two of them are used to, I'd say the olden days, makes me sound really old, but in the olden days, these two would correlate almost perfectly. And by perfect, I mean a correlation of, well, not quite unity, but certainly within the high 90s, so minus 0.95, 0.96, something like that. You would see these two moving diametrically opposed. You could put one chart on the other, and the two of them would be moving in almost precise different directions to one another. But clearly, as you can see now, that's not the case, just to see what it is on the daily. Okay, so when we go down onto the daily, now you can see it is a much closer relationship. It's minus 0.93. And that is a very strong inverse correlation. The negative just shows you it's an inverse relationship. And that is typically what you want to see. So what that's telling us is that, yes, on a daily basis, on a slower time frame, there is a strong inverse correlation, and that's maintaining. But on the intraday basis between the two, it's not. It's broken down a bit. So don't expect to see dollar Swiss and euro dollar move in opposite directions perfectly on an intraday basis, because they won't. If you look at, let's have a look. Let's go back to the hourly. Back onto the hour there. Let's just have a look and see if any of the majors are correlating particularly strongly. Okay, a cable here you can see very strongly positively correlated with euro dollar. So if you're trading baskets or you're trading something with pound and euro against the dollar, then those two are at present very strongly correlated. So as one moves up, the other will move up, and as one moves down, the other will move down. Very strong relationship. Basically, rule of thumb, anything I would say above round about 0.85 or 0.8 absolute bare minimum is good correlation. Anything below that is really not correlating very strongly at all and can hardly be described as correlating. So you can pick the numbers off here for yourself. You've got the dollar CAD there, inverse, decent inverse correlation here with Aussie dollar. What else have we got? There we are, dollar yen and euro dollar. decent inverse correlation there, and on cable as well. It's always interesting to look at correlations. There's a great site called Mataf. Used to be mataf.net. I think if you put mataf.net in, it'll pull up where it is at the moment. I can't remember what it's called now. I think it's something different. But that will give you all the correlations and lots more pairs as well. I haven't got them all on. This is an app that comes with NinjaTrader on the control panel that you can just pull up. I've got the currency matrix run across the top there, 1 through 5 minute, and I've got the currency array isolated out on euro. Just want to see what euro is doing over here. The weakest euro pair at the moment is euro Aussie. Right down at the bottom here, you probably can't see it, but all of these are euro pairs. So we are below the horizontal. In other words, we're below the fulcrum point of 0 where we turn from bullish to bearish. So all of these are bearish. It's just a question of degree. Euro dollar is in the middle here, and you can see them ranked up and down here on the ladder. Now, if that bearish sentiment for euro is going to continue, if it is euro driven, then all of these pairs will start to stack up down here. This is only one time frame, 5 minute, and obviously you'd have this on different time frames. But it's a great way to isolate what is going on in terms of whether it's euro driven, whether it's dollar driven. Now, if you look over on the currency matrix, if I just isolate out the euro there for you, similar sort of picture. They're all stacking up or tending to drop down here into the red zone. Euro Swiss is the lowest here. We've got euro dollar. That's just popped up there, one space. Remember, the look back period between the currency array and the currency matrix are very, very different. The currency matrix has a short look back period of 7. The currency array has a much longer look back period. So if you're an intraday trader, then and certainly a scalping trader, then you should be using the currency matrix because that is the fastest one. It will move very close to the price action because it's only looking at 7. This one is much more of a trend or swing trading application where you're looking at it from a longer term perspective, because people say, well, what's the difference and why am I seeing something different on currency array as opposed to currency matrix? And that's the reason why. You can check it out. Those of you who've got the indicators, you can check it out for yourselves just by looking in the back end and seeing what the setup is. I can't actually remember what it is on the currency array. Let's have a quick look. Look back period is 80. So it's 80 on the currency array, and I'm pretty sure it's 7 on here. Click on there. There we go. Look back is 7. So that's the reason there is this difference. And as I say, the currency matrix is a scalping tool. The currency array is much more of a trend or swing trading tool. Let's just put that back on where we're isolated out. Let's just see what's going on in terms of the dollar. Nothing particularly.
I think it's waiting for Wall Street.
Yeah. What you want to see, ideally, of course, on any of these indicators is you want to see stacking. So on the currency matrix, you want to see the pairs that you're looking at. If we're looking at dollar selling of the dollar, then you want to see the pairs moving upwards. Downwards. And if you're buying, then it's vice versa. So you want to see the pairs of interest or the currency of interest. You want to see these, for example, if you want to see strong buying of the dollar, you want to see these migrating up to the top of the matrix, and you want to see these equivalent pairs moving down to the bottom of the matrix. It's pretty much what you've got over here actually on 3. That is what I call a full house. It's a perfect combination. You've got 3 at the top, 4 at the bottom, and they're telling you that in that time frame, in 3 minutes and possibly from 1 minute, isolate out on 1, not so much, but certainly around the 3 minute time frame, it's reasonably strong buying of the dollar on an intraday basis. But it's really not converting to anything strong in terms of the 5 minute, because you use multiple time frames, whether you're on a chart or an indicator, you use them in much the same way, because when a trend starts or a buying of a currency or selling of a currency starts, it will start in your fastest. So it will start over here on your 1 minute, and then it will move to your 3 minute, over to your 5 minute, out to your 10, 15, 20, and so on and so forth. So you use the indicators in precisely the same way. So what you're looking for is if you're looking for dollar strength. So let's say, for example, you want to see it over here on 1 minute, then you want to see it come into the 3 minute, and ultimately you want to see it migrate over onto the 5 minute. In other words, all these currency pairs moving upwards, all these currency pairs moving downwards. If you're not seeing that, then it's not a strong trend that's developing. We're just oscillating. We're not going anywhere particular at the moment. And that's really what that's telling you right now. So let me just put these back now to where we were. Sorry, Don, did you want me to cross over or? No, that's fine. No? Okay. All right. Okay. We're over time anyway. Apologies. So I've been rambling on as usual. So there we go. Let's just put that back on there. Just put that back on. There we go. So they're all neat and tidy. There we go. Okay. So there we are. That's where we are in terms of the indices. I think everything's waiting for the markets to open, which they will now do in about 20 minutes or so. Just to wrap up very quickly, this is where you find all the details on the indicators at quantumtrading.com. All 4 platforms there, MT45, NinjaTrader 7.8, TradingView, and TradeStation. MT45 is one license, so you get both platforms. The same with NinjaTrader 7.8. One download, you can use 7 or 8, you decide. If you've bought one indicator from us in the past 11, 12 years, it doesn't matter when, we'll have you on the system. If you're looking to upgrade, maybe to buy another indicator, or you want to upgrade to a program, or you want to upgrade to a bundle, or you want to go to the education program, absolutely no problem. We will credit you with whatever you've spent with us, so we will always have you on the system, and you will never lose out in terms of credit that what you've purchased from us in the past. If you invest in the full package with us, then you get all indicators we develop in the future free of charge. And all these indicators I've mentioned, or certainly some of them, the MSI, the VRSI, we've got what else have we got? We've got the VWAP, which is a multi-indicator version of the VWAP with 5 versions of the VWAP on it, the MVWAP, the anchored VWAP, we've got the time VWAP, we've got an intraday VWAP, and one other moving average, and the VWAP itself. All those indicators, if you're an existing full package customer, then you will get those indicators free of charge. I have to say that when the stock program is rolled out, then the full package prices will be going up as well to reflect that. But thereafter, you will then get any indicators we develop again free of charge in the same way as at present. This is the stock trading, the complete forex trading program, and soon to become joined by the complete stock trading program. It really does cover everything you need to know. We put a huge amount of effort into these programs. Bear with me one moment. Sorry. We put a huge amount of effort into developing these programs. The Forex programs took us 2 years. The stock program also has taken us nearly 2 years to put together. It's massive. It covers everything you need to know and understand in order to take on this market, which is challenging, but we put it all in there. And in addition to that, we've also added the funded program now, so that this is only available to students. It's not available to anyone else. But once you become a student on the program, you can take advantage. You can take up the funded program, and basically, it's trading our money. We give you our money to trade in the market, and you start with at an evaluation level right down the bottom here. You select which level you want to begin at. You can start with a $5,000, a $10,000, or a $15,000 account. It's as simple as that. You pay a one-off entrance fee here. Think of it as an entry ticket. That's it. That's all. That's the only cost to it. There's nothing else. You can't lose anything because this is not your money. Of course, there are risk and money management rules in there. We have to protect it, but it is our money and not yours. You earn off the program as you basically you'll set a target for each level. Once you achieve that level, we give you a kickback in terms of any percentage of the profits made. And then you start to move up to what we call the portfolio manager level, where we multiply everything by 4. So if you start with a 15,000 account, once you've achieved level 1, your evaluation stage, it's basically you putting your knowledge to the test. That's the reason we put this program in place, is to allow our students to take advantage of their knowledge, but using our money, not your money. and we felt it was important. And once you've proved to yourself that you can be consistent and make money consistently in this business, then you go on up to the next level, and we multiply it by 4. So you go to 60,000, and then we go 120,000, 240, 480, right the way up to 2 million at the top of the tree. And you earn all the time. I think it's 50% profit on, forgive me, I'm pretty sure it is 50% profit on whatever earnings you make in terms of targets achieved as you go through the program. So there's always an incentive there, and you get part of the profits returned to you as a result. Finally, over on Anna's site, annacooling.com, this is where you'll find all the books which are up on Amazon, either in Kindle or in paperback version. We are endlessly humbled by the comments, and also if you follow Anna on Twitter, she's got a massive following on Twitter, and some of the comments, many of the comments we see there for traders who've embraced VPA, are so grateful for having discovered VPA through the books and through the education programs. And it's very humbling to read those public comments up on Amazon and also on Twitter. So these are all the links, and this is where Anna puts up a lot of her analysis, and also you can follow her on Facebook and on Twitter down here. So that's it. Thank you so much for coming along today. Really appreciate your time. We are back later at 8 p.m. UK time, which is 3 p.m. US time. Forgive me if I'm incorrect there, but I'm pretty sure we're still 5 hours ahead. And we look forward to seeing then. If not, enjoy the rest of the trading day. Enjoy the rest of the week. Have a great weekend. Stay safe. See you soon, and bye for now.